So what's happened this week? So the Fed minutes have come out and they put a June rate rise back on the table. That's contingent to a pickup in the US GDP and labour market and inflation expectations. This was a big surprise for markets. The March message was that the Fed would not be preemptive. Markets were extremely dubious about the logic of this. If you look at the growth expectations of the markets, they're very low at the moment, and therefore raising into those conditions has a high probability of reducing the market multiple. So what we expect is stronger US dollar at the back of this change in policy. That puts pressure on risk assets, and emerging markets tend to underperform, and we expect to see the RMB, the Chinese currency, underperforming or depreciating against the US dollar, and that was a trigger for issues earlier in the year. What this means for the market is that the poor performers from 2015 who've been leading the market this year, the energies, the materials, the consumer staples, we feel there's a possibility that you might get a change in leadership if the US dollar starts to appreciate and we see that emerging market components start to sell off. And we think we could see a bit of a reversal because financials have been very weak. They're beneficiaries of rates going up. Consumer discretionary technology equally been weak this year. We may see a little bit more strength coming into those sectors. What this means is that we're now back in a position that we were in 2015, where the Fed has been moving from threatening to raise rates to being more loose with their policy. And why are they doing this? Because it's creating unnecessary volatility in markets and damaging sentiment. It's because they're now operating within the confines of the global macro situation. If they're too loose with their macro policy, then we'll see internal inflation. We're seeing with rates too low, the bank transmission mechanism is being damaged. We're also seeing tighter European conditions because of a loose US policy and equally unconventional policy coming through in Japan, and that clearly is going, can go too far. If they raise rates too aggressively, then you can see a strong US dollar. You see problematic issues in China because they're pegged to the US dollar, and you also see a weaker emerging market. So that can shut off global GDP growth. So what's our response to this? Well, we continue to feel that where there's big macro uncertainty, we can still find great micro visibility. So we continue to back businesses that are able to operate in this highly uncertain, bigger picture world. So looking into next week, it's a relatively light reporting week for us. We've got Marks and Spencer's coming in on Wednesday, but the emphasis really will be on the macroeconomic data that's coming through.